Good afternoon, everyone. Rich Swerbinski with the Mortgage Collaborative, uh, here with a new endeavor on our TMC Connect platform. Let's talk housing stocks. See everybody just getting logged down. We're going to give everybody a moment or two to do that, and then we'll go ahead and get started. All right. Good afternoon, everyone. Rich Swerbinski, President and COO of the Mortgage Collaborative, here with a new addition, a new installment to our TMC Connect platform, just based on all the companies in the housing sector going public over the course of the last 6 months, more scheduled to do so here in the coming months. Just a lot of interest in general in the stock market. Wanted to dedicate a monthly program to housing stocks and the stock market in general. And I am very pleased to have as my co-host for this, Phil Newton. Phil is the co-host of the Rebel Traders podcast, one of the more listened to podcasts. It focuses on the U.S. stock market and investing. Also involved with an organization called the Anti-Vestor. And Phil, you've spent really your entire adult life really tracking and following the U.S. stock markets. Why don't you start out by telling us a little bit about yourself?
Well, I think I could be summed up very quickly. The guy with the weird accent at the other side of the pond is a stock nerd. That really summarizes everything. I knew I'm one of these fortunate people. I knew what I wanted to do quite early on. So I pretty much started out hand drawing charts in my mid-teens, got hooked on it. Probably like most of the fever that everyone's experiencing right now. That's what I did in isolation all the way back then when I was 17. And it just kind of took off from there. Placed my first trade at 18. And that was my kind of crack dealer's entry gateway drug, was that first stock purchase. And I've been hooked ever since. I've made a career of it. Despite my youthful visage and good looks, I've been doing this for well over 20 years now. I like to have a laugh. I don't take life seriously. You can also probably tell as well. We've been the royal we, me. I've been doing this for 20 or so years, trading stocks. Started out trading currencies, futures. Primarily, I trade stocks, US stocks, and stock options is what I focus on right now. So there's not much I haven't traded, and maybe we can explore some of that, during these conversations.
Awesome. No, I appreciate it, Phil. Appreciate you joining us. And yeah, gotta love just technology in general. I had the idea for this show. I know just enough about the stock market to be dangerous. I know the mortgage industry, but I'm like, I need somebody that knows much more than me about the stock market. And we'll kind of take a cold, ruthless.
In the absence of that person, you phoned me.
Investors look at the stock market. We're connected on LinkedIn, and I appreciate you joining me for this program. So let's start. Somebody that's been following the stock market for over 2 decades now. This last year has been crazy, right? I mean, a lot of new people in the stock market. It's been popping hard. I mean, just your general observations on the stock market in general these past 12 months.
If we were having this conversation prior to the last year, I'd probably come up with some fancy straight out the textbook comments, just like everyone else. It's been a weird year. It really has. For anyone this is the first time they're looking at the markets in any serious way. It's like watching multiple years of behavior, of ebbs and flows, almost like seasons. Watching a movie showing the seasons, like a time travel movie, where you do the window change and it changes all the fashion. It's like watching it compressed in the last 12 months. That's really what this last year has been. It's just so compressed, very wild moves. And it's not normal. I think that's really what's coming out. And it's primarily driven by the fact that no one's got anything else to do, and everyone's kind of sparked an interest. And it's not just the US, it's a global phenomenon. People want to do something, and that's kind of what we're seeing unfold in the market. So everything is speeded up. The recovery, most people are thinking, like myself, we were going to see a double dip. It was going to crash again, retest the lows, but no, it recovered. And it's unusual. It's a historical precedent. And I think that's probably what most people don't realize. This has never happened before. And I've looked at the recoveries of similar crashes, not the wide things crash, but historically over the last 100, 150 years. Like, this type of behavior doesn't happen. So it's very bizarre, and a lot of, myself included, I'm not ashamed to admit it, we are scratching our heads over, like, this shouldn't be happening. I mean, this week's a great example. GameStop, this shouldn't be happening. It's like, don't get me wrong, things like that do happen, but not at the magnitude that they are happening. That's what I mean by it. Like, it's weird. It's like, whatever you've seen previously, it's been put under a magnifying glass and exploded to an even more dramatic extreme. So it's a very crazy situation. It's great to learn, great volatility, creates great movement, great opportunity. But what we're not hearing the stories of yet are the sob stories, the heart stories, the catastrophes of where it didn't work out, because people are quite literally betting the farm. And they, for the moment, getting it right, because stocks only go up, and that's everyone's experience. And doing this for a career now, like, I know it's a house of cards that will come tumbling down at some point, and it's going to be painful for some of those people if they're on when they're on the wrong side of it. And maybe we can educate some people of how to minimize, prevent, maybe even profit from that downward movements.
Before we get into, housing and mortgage related stocks, I mean, just more broadly, is this the dawn of a new era with the stock market? I mean, obviously spurred on the 0% interest rates and stimulus money, everybody being home, not as many sports betting options, all these new retail traders, platforms like Robinhood, where you can trade options and regular trades with no commissions very easily from your phone. You mentioned GameStop, the whole Main Street versus Wall Street kind of battle that is waging right now. Certainly no shortage of commentary. Anytime you've turned on any cable news network, is this the dawn of a new era for investing and trading in U.S. equities?
I'm going to give my stock answer. No, is the short answer. Nothing's changed. What happened with GameStop and similar stocks, pump and dump is maybe a phrase that you've heard, that type of stock. There's a book that you can read. It's an easy read, Reminiscence of a Stock Operator. It was written in 1926, published in 1930, and it was about a period of time in about 1905. So like 115 years ago. And what we saw with GameStop and similar stocks, the pump and dump, there's a chapter dedicated to this pump and dump situation. Although back then it was legal to do, you could go and do it, no one cared, but the laws changed. So like this is nothing new is all I'm trying to say. I think to answer your question, what about this time? Is this time different? No, it's not. As I alluded to earlier, I think the speed of which things are happening because of technology, because we literally are all carrying computers in our pockets, like powerful computers. When I started out, I was hand-drawn charts, like household computers were just becoming a thing, but now everyone's got one in the pocket, digital access, the speed of information, it's instantaneous. Everyone's a reporter, as we know, thanks to Twitter. I think that's the thing that's changed, the speed of information. And as I said before, this last year, what we've seen in the last year, that would normally happen over 4, 5, 6 years. It's all happened in 8 months, pretty much back to where we were. And that's normally a 4-year cycle. If you look through history, anywhere from 2 to 4 years is what a bear market correction would normally last for. And that's what we're not seeing since 2008, really, since the last crash and the last recovery. And that pretty much is what I see has changed, just the speed of with which things happen. Again, it's that's what makes it a little bit bizarre. That's what is changing. I'm not got a better answer for you, unfortunately. No, nothing's new.
I'm here with Phil Newton, co-host of the popular Rebel Traders podcast and of the antivestor.com, talking housing stocks. Let's start, Phil, just the U.S. housing market in general. It's obviously been a great year for housing in the U.S. We've had Fed-fueled low interest rates. It's been a very good year for housing in general. As we head into now the bulk of 2021, most of the economists are projecting another good year for the housing and the mortgage market, depending on who you look at. Home sales up 10 to 20%, 2021 versus 20. How do you, I'm in the housing industry. I, live and breathe it every day as an investor. How are you looking at the U.S. housing market as we head into 2021 here?
Well, first thing, you said an interesting word. You said as an investor. And I think it might be worth clearing up. I'm not an investor. I'm not Warren Buffett. I'm not holding or investing in good companies. I don't care if a company's good. I don't care if it's bad. I don't care who the CEO is. I don't care what profits you're expecting. I'm what they call a trader. I will profit from the swings in a stock's price, up or down. I'll profit both directions in the markets. So what you're asking about is investing. What does the next 5 years hold? Warren Buffett may be a name that some people have heard. You've got a time horizon of many years. Is the industry, is the sector a good investment? So I don't look at things through that lens. I'm not looking at, is this company, is the sector, is it profitable? Is it going to grow? I just want to know, will the stock move? So that's a very, I think, important distinction at this stage to make. I just want to know is instead of thinking, is this a good investment? Will my investment grow over the next 5 years? I just want to know three things. And my focus is, am I going to get paid at the end of the day, the end of the week, or the end of the month? And I don't really care if it's a good company or a bad company. I'm a momentum trader. I'm looking for a stock to move and I'll profit from that movement. So does that kind of ring true, first of all, before I try and answer your question? Because my answer about an investment is I don't know and I don't care. And that's truly the honest answer. I could give you the chart analysis of what I think is going to happen over the next 12, 18, anywhere up to 2 years, because the charts looking at the price behavior will assist me with that. But again, I'm not going to try and blow wind in anyone's sails. I honestly don't know anything about the sector. And for the way that I approach the markets, it does not matter. That doesn't mean to say that I don't have an appreciation for what's called fundamental analysis, that who the chief executives are, what the company's doing, what they do, are they, do they have good cash or bad debt, or all the other things that go into making an evaluation of what a good business is. Is it a good investment? I don't want to read company reports. It's not my personality. So if anyone maybe is thinking about, like, what should I do with the markets? Is it an investment or trade? Maybe that's the first question that you should ask yourself. Do I want to invest and be like Warren Buffett? In which case you probably are going to look at the business, the fundamentals, the company reports. Is it a good business? Can I buy it at a discount? Is what Warren Buffett might do. Me personally, I'm going to be looking at, is the next swing going to be up or down? And will it move today, this week, or this month? That's all I'm focused on. So I'm going to be more focused on the pretty pictures that we call charts that you might have seen on the news. And I completely didn't answer your question because I've not got a good answer. I'm not an investor, so I'm not going to try and, I can't give an answer is the answer for you there, just for that reason.
No, that makes perfect sense. So, talking about stock moves and more technical trading analysis of stocks, it's been big news in the mortgage industry. There's just been a lot of companies in the mortgage industry going public. Really, until, 5 or 6 months ago, you had Mr. Cooper, you had PennyMac, were really the only two really large publicly traded non-depository mortgage companies in America. Now we've had some new entrants, obviously Quicken Loans, Rocket Mortgage, IPO'd, I want to say about 22. It shot up to like 32. It's down around $20 right now. They're the biggest mortgage lender in America. The second biggest mortgage lender in America just IPO'd last week, United Wholesale Mortgage. They did that via SPAC, obviously one of the big trends of the last year. The SPAC kind of was living between 11 and 1350. And last time I checked this morning, United Wholesale, which is a very quickly growing, very profitable, massive mortgage machine, has sold off and below $10 a share. So what do you make of these new entrants into the mortgage marketplace via IPO and just that space in general?
IPOs stands for initial public offering, if anyone wasn't aware. IPOs are a little bit differently. What you've got to keep in mind is an IPO is an exit for the pre-public traded stock investors, because they've probably been invested millions, hundreds of millions in making that company a good prospect to launch on the stock market. And there could be anywhere from 18 months to a couple of years while they do whatever they do, bring in management team, make it a good business, put company structure in place, grow it. The reason for those people who are in before it's a publicly listed company, the IPO is their way of getting paid for the investments. So does that part make sense? Like, I know you may know that, but just pop a little comment in the chat box if it doesn't make sense, or you're kind of with me on that. But essentially, that's how they get paid. So most of the time after an IPO has launched, and on the day of the public listing, it now means that anyone with a brokerage account can go and buy or sell shares. All those people who have bought the share or invested in the company, they want to offload, they want to cash out. And there's usually a period where the management team can't physically get rid of their investment or cash out or take some profits, because they will have options and shares issued to them, on the IPO. So there might be a grace period, a couple of weeks, a couple of months before they can cash out. They can take a profit from all their hard work and labor for the past couple of years. So this is probably what we've just seen with UWM Holdings, was it that you mentioned? It's going to go sideways. And normally on the IPO, they drift sideways. And usually most time an IPO will sell off because there's a lot of people exiting their positions, their investments. So all that selling pressure, the downward movements, is those investors closing their positions. So the obvious thing most of the time for me, if I'm gun to the head scenario, if you've got to trade an IPO, I'm probably going to short it. I'm going to profit from the downward movements, because that's what the money flow in the short term is doing. Few exceptions to every rule. I would look at a benchmark. If you are looking at IPO stocks, is it above the IPO price, the price that it floated on the day of the launch? Is it above or below that? I think that's a good benchmark. If it's below it, leave it alone. Don't worry about it. If it's above it, maybe you can start looking for an entry. Other exceptions to the rule are, like, if you want to be an investor where you've got a many year time horizon, where, okay, I'm going to have this stock. I think it's a good company. I believe in it. The management, investments, many years down the line, I'm going to get good dividends. That's what I'm expecting. If you think it's a good investment, then the share price today doesn't make that much difference. But just be aware, the behavior around an IPO is very different from a growth stock, a stock that is trending, it's moving, it's growing, it's making profits, they're getting more customers, they're acquiring more business. It's a different behavior and a different reason why you'd be trading that particular stock. Generally, IPOs, I don't touch them for all the reasons that I've mentioned. They're not that. There's not that much movement one way or the other for a little bit of a while. There's a little bit of a knee-jerk reaction, but for the way I want to trade, it's not something that I would typically look at. So yeah, it's an exit for investors.
No, it makes perfect sense. Thanks, Phil. With Phil Newton of the Rebel Traders podcast, Rich Swerbinsky with the Mortgage Collaborative, talking housing stocks. And Phil, let's turn our attention to the home building sector in America. Just a lot of talk here domestically, just a kind of perpetual problem that is probably at its apex right now. Is just an inventory issue in America, right? More people that want to buy homes than there are really sellers. It's driving up home prices. Some people worrying about the long-term ramifications of that. As we look at the home building sector, there's certainly a lot of demand for new homes to be built in America, but there's also a lot of headwinds. You've got, a lack of buildable lots. You've got a lack of skilled workers, and inflated prices of, key building materials like lumber. So, kind of an apex there, a lot of debate as to which way new construction will go this year. How do you look at that sector? Obviously, almost all the biggest home builders in America are publicly traded companies. Anything particular to that sector or any participants in it that's caught your eye?
Yes, I've got to admit, out of all the kind of related and ancillary sectors around what you do, this is the sector that does get me excited the most. It is a sector that I do trade stocks in. And for all the reasons that you mentioned, those fundamental reasons, at its most basic, supply and demand 101, if you've got more of something, it's worth less. If you've got less of something, it's worth more. Supply and demand. And that's what's creating these opportunities. So yeah, this particular sector is a great growth potential just because of those issues that it's creating those opportunities. Stocks are starting to increase in value at a steady rate. They're not exploding unjustifiably, like the GameStop example. It's an unjustified reason for a stock. There's no value in it. So that's going to disappear, and you'll see that over the next few days. So right now you've got a like Toll Brothers, TOL. That's one that catches my eye. And if you want, I can share my chart and kind of trying to describe what I'm seeing, if that might help, just put a visual, because for me, it's a very visual way of trading, whether we're looking for a few days or a few weeks or months. So I've got a list of our stocks here. We've got this in a spreadsheet. If anyone wants, I'm sure you can message one of the administrators and you can get a copy of the spreadsheet. So if you want to track along, there's a list of stocks that we're looking at and we can just see whether it's up on the year or down on the year. So if you want access to that, because again, I appreciate not everyone's got the fancy charting. So it just help you keep track of some of these things that we're looking at. So the home builders, again, Toll Brothers catches my attention. One of the things that I'm looking at before I try and explain what I see is I'm looking for three things. I want to know if a stock is going up, down, or sideways. So visually, I'm looking for like an upward zigzag. And apologies if this is a little bit basic for some people. I'm just trying to kind of talk to the, if this is your first day type of thing. The second thing I'm looking for is it zigzagging down? That would be called a downtrend, because if you weren't already aware, we can profit from downward movements in stock prices, which is a great thing. We can profit if a stock goes up, we can profit if a stock goes down. And then the third thing I'm looking for is it kind of zigzagging sideways. We'll call that a consolidation. You could almost put a straight line ruler above and below it. That's what we're looking at. And it's most basic. These are the three things. So when I'm looking at a chart, I'm trying to determine over a longer period, what's this chart doing? So we can see here that Toll Brothers is, since the March, April lows, it's been on a very steady uptrend to about this point, about October. And most of the market last year kind of started to consolidate from September onwards. And then over a period of time, we can see that we could also put a straight line ruler, connecting these lows. And similarly, we could say that it's contained there. So now that I know this, and all I've done is try to identify which parts of the charts are going up, which of them are going down, and which of them are going sideways. That's what I'm trying to do. There's only three things that a market's doing, but I can break this chart down into two distinct trends. So now I know that it's going up. Now this is important because this is what a good trend, a good investment opportunity is going to look like on the charts. It's going to be steadily going up. It's not going to be going vertical straight up. It just wants to be gradually going from the bottom left to the top right. And this is what I'm looking for. So now I can say, well, where is price right now? So it's now above this consolidation period here. So it oscillated sideways, wasn't really going anywhere. And because the prior move was up, the trend was up, what I know from research is there's a 65% chance that that trend is going to continue. So we can call this a breakout. It's breaking out of the sideways trend and might be resuming its upward trend. So does that kind of explanation make sense before I kind of go any further?
Yeah, it makes perfect sense. No,
okay, cool. So why is this important? Because I just want to reiterate, why do this? Because this is the money flow. It's not, despite the headlines we've seen over the last few days, retail traders don't create long-term sustainable trends. Institutional traders, institutional investors do. So the money flow is saying that people are prepared to pay ever increasing higher prices. So this is what it looks like. So now it looks like it's resuming its upward movements. I can wait for, and this is the trick that maybe most new traders and investors wouldn't think about doing. If you want to buy the retracement, so I just want to wait for it to pause briefly, 1 or 2 days minimum, and then wait for its next push higher. And that for me is what I'm going to be looking for. Just like over here, when it did something similar, it rallied, it just paused for a few days, and then that's going to offer me a good low risk, high reward opportunity. So where could Toll Brothers go? One of the things I like to do is just measure the last trend. So the last trend was sideways. So I'm just going to get a little tool here. I'm going to measure the height of that. And it's looking like it was about $10. And I can just project that upwards to give me a best guess. Because let's face it, I don't know what's going to happen any more than the next person. But what I do know is that these trends are predictable. So we can look at Toll Brothers as saying, yeah, this has got a potential to move up to $60. I'm going to be a buyer and expect it to move from about $52 where we are right now. If I can get in lower, I will. But if it was to move higher, I'll be looking for it to move $10 high. And this is what I do on a kind of daily basis. So this is the one that really catches my eye. Would I buy today? No, because it's rallying in what could be a new uptrend. Another example of this
bought
is
a couple hundred shares while you were going through that. So
HOV. Yeah. See, if you're going to invest it, then the price today is not that important. You know, it's going to swing up possibly to $60. Another one that I like is HOV. Don't press the buy button just yet. So this is an example of like, the ship has sailed. It's done the same thing. It's broken out. But what I don't want to do is buy the rally. You may have heard phrases like buy the dip. So if I was to get in here now, I'm buying the rally, and it may continue to go higher and I may get lucky, but it's buying the rally as it moves higher is what causes people to panic, because what is going to happen next? It's probably going to pause. It's probably going to retrace. So what I would wait to do is wait for it to retrace and buy it at a slight discount to where it is right now. Just wait for it to pause, rest for a few days, and then capture the next leg of the movement. And you're not going to miss the boats. This is a game of patience. Because if you look at the last time this happened, we've got a big rally here. It retraced plenty enough to give you an opportunity over many days, even weeks, to get you profit on that next leg of the movement. So you've got opportunity to wait. You don't have to jump in at the first sign of it moving higher. If there's going to be a good, long, sustainable trend, it's going to go for days, weeks, and months. So don't worry about getting in today. Don't buy the rally. Wait for the retracements, is what we're saying. Again, the home builders have got some, again, great opportunities. So there's just two of my favorites right now. So this is a good example of what I'm talking about. We've got a little bit of a range here inside the large range. So what do I mean by buy the dip? So there's that consolidation, again, well-defined inside a larger. So you've got that rally there. So that retracement is, now we know that, hey, I'm 65% of the time, it's going to break out. It's breaking out, moved above the range. It's retracing a little bit. Those red candles are a downward movement. And when it goes above, say, the last red candle, then I can start thinking about buying. So that's what I mean by buy the dip. It's rallied, retracement, a move down, a dip in the context of an uptrend. That's going to give me my low risk entry opportunity. Because if it doesn't go my way, I don't want to hold the bag forever. Again, similarly, again, just eyeballing this 40 to 60, it's got a $20 potential. So from 60 to 80 is where it could get to. And again, we can get in around $60, we can get the full $20 potential. That's why we're waiting for the dip. We're not going to chase the rally. And if you miss the move, you've got to miss the move, but you're waiting for the best opportunity. And if it doesn't work out, you can set a stop loss, because we don't want to bet the farm. We want to be in business tomorrow. We're going to have a small percentage allocation. We're going to say set a stop loss at the point where I'm going to get out if it's not working. I can always get back in again later, but I don't want to sit in this. I don't want to sit in this sideways for 6 months. No one wants to do that. I want to get a good trade today. And this is why I do the charting. It helps me with something called timing. So this looks like a good time, $60. If it's not working out, again, I'm just approximating $50, $55 is where I'll place what's called a stop loss. That's going to be where I'm going to exit if it doesn't work. And again, aiming for $80, because that's where I think it could get to. And all I've done to do that is just measure the height of that range, the sideways movement. It's very clear, and just projected it upwards. So we've got a good $20 swing on and this is the ETF, the exchange traded, the fund. So it's built up of several stocks, like the S&P or the Dow. It's an index of multiple stocks. So the sector as a whole is looking charged to move higher. So again, I really like the home builder sector. And to be fair, I wasn't looking at it before we had our conversations, but I'm looking at doing something with it, as you can see here. There's no reason not to, as far as I'm concerned.
Got a couple minutes left with Phil Newton of antivestor.com and the Rebel Traders podcast, talking housing stocks. If anybody has any questions or comments for Phil, this would be the time to do it. Phil, before we go, other sectors of housing with some public companies, the mortgage insurance space. We have TMC partner companies, MGIC is one of those, Essent and Radiant, some others in that space. The online kind of realty and realtor brokerage space, Zillow, Redfin, Realogy, anybody in any one of those verticals that has caught your eye from a technical perspective?
I've got to admit, nothing's catching my eye more than the home builder sector. Maybe if I just go through, and it might be worth just showing what I'm not looking for. What a bad, not necessarily a bad stock. It's just like today's not the day. Like go and look at something else. This is IVR, mortgage cap. I think this is an ETF. It's dead in the water. It's going nowhere. I don't trade penny stocks, and don't be enamored by the low cost of a stock. Just because it's got a low price point, it doesn't mean that it's cheap. It doesn't mean that it's inexpensive. It doesn't mean it's good value. It means it's like it's low for a reason. And if you think about the way that the stock market's been over the last 6 to 8 months, the whole stock market has been divided into two: the stocks that are participating in the recovery and the stocks that aren't. And this is clearly an area that's not participating. And what you'll find if I just go through them quite quickly, the MBS investing kind of sector, we can see it sideways. No one's interested in this. This is what this is telling me. Visually, we can see it starts in the middle of the chart. It finishes in the middle of the chart. This is a 12-month period. From almost the end of March and April, you can see the big crash. It's going nowhere. And what you'll see is when you've got a nice visual reference. And if you want to kind of look at charts, there's lots of free charts. Tradingview.com is a nice free platform. If you want to plug in some of these symbols and you can get free access. I don't even think you need to register. They've got a nice little online platform. These stocks, they're not going anywhere. So again, the investors sector, they're not doing anything to justify being excited. And remember when we looked at, where was it? Toll Brothers. Again, just go back to Toll. Again, Philip Morris is another, not Philip Morris, Pulse Group is another one. We've got that potential. It's moving. It's at the top of the chart compared to, start at the bottom left, finishes at the top right. We could argue it's a trend. Visually, these stocks look much better. They look like they're starting to move. Again, we're back on the home builders. Again, the names don't matter for the moment. It's just generally the home building sector. They're all starting to move up. HOV is one. Again, that's the rally in an uptrend. Don't worry about getting in now. Wait for the retracement. There's going to be plenty of opportunities to get in if there's going to be a move in the sector. But let's just come back to some of the other stocks. Title insurers. It's not really that exciting by comparison. If we're looking for a good move, a good opportunity to join the trend, there's no trend here to join. Is that kind of logic ring true? It's like, I could buy shares, but they're probably going to carry on going sideways. And those are the thing to keep in mind. And the thing that I've spent and learned and relearned so many times over the last 20 plus years of doing this is that whatever the chart, the price, the stock, whatever it's currently doing, until something new happens, nothing's going to change. And that's true with life. That's true with psychology and human nature. And that's what we're really trading here. If nothing's changed, then there's no opportunity. So when we see the stocks start to move favorably, again, just going through some more title insurers, this one's probably the best out of these, but it's moving. There is an opportunity here compared to some of the other stocks, but it's not great compared to the home building sector. And then when we carry on going down, hopefully visually you can see it's sideways. Until this changes, it's going to carry on. Nothing new is developing. So something new might be classed as, well, let's just draw a horizontal line above the high of this range, somewhere around $58, $59, just to approximate it. When the stock price goes above there, that might be telling me that, okay, now's the time to get interested. It's not the time to place a trade or think about an investment. It's just saying now it's starting to be interesting. That's a time where you can start thinking about, okay, maybe it's starting to trend. Maybe I can get the next dip, the next retracement, but don't worry about an immediate move. Because again, if this is going to be a legitimate trade and trending opportunity over, weeks, months, maybe even years from an investment perspective, there's going to be plenty of opportunities. You don't have to worry about picking the top or picking the bottom, because the institutional investing money is going to drive prices high, maybe for many weeks, many months, maybe even many years in some cases. So wait for something new to happen. So title insurers, they don't excite me. The services sector, again, kind of better, but it's still not exciting. When we start going to certainly the real estate management, we're into penny stock territory. This doesn't excite me ever. Usually I don't trade stocks that are lower than $25. Because they're lower than $25, I don't typically trade penny stocks. They're cheap, they're inexpensive. They're cheap and inexpensive for a reason in my mind. I'm looking for movements. We profit from things that go boom, but we don't want them to explode. Again, like GameStop, that's unusual. That doesn't happen every day. What we're looking for is steady gains, steady movement, steady opportunity. If I don't get it this week, I'll get it next week. That's fine, because that trend, when it's established, it's going to go on for many, many years. Again, let's just go and look at Apple, just so you've got a visual cue for this is what happens. I'm going to change the time frame to weekly. So each of these little red and green candles, this is a weekly chart. It's been a steady trend up and down, up and down, up and down for many years. If you didn't get the buy the dip, the buy the retracements, in any of these locations, well, there's an investment opportunity. So investors will typically look for, when there's been a long-term trend, they're going to wait for 10, 15, 20% drop in the stock price. And as you can see, that can happen over many, many months. So when it resumes its uptrend, when it resumes the upward movement, we can start to buy those dips, and then they're going to go on for many days, many weeks, many months. But what's the right thing for you? Do you want to get paid at the end of the day, the week, the quarter, the month, the year, the decade? That's going to determine how you approach this. If you're thinking investments, you've got weeks, if not months, to think about the right time for you and when the trend is starting. If you want to get paid at the end of the day, we're looking at intraday. I'm day trading at the moment. It's great environment for that. If you want to get paid at the end of the week or the month and do short-term swing trading, which is the other style of trading I'm doing, you're going to be on a daily chart. And all you're doing is waiting for the rally, wait for that retracement, pick a point halfway down that retracement. And then when it starts to move higher, that's a good place to start thinking about, is this the right time for me? I can't say for certain because I'm generalizing, but it just gives you a benchmark. Don't worry about trying to get in on the rally up. Wait for the sell-off. That's what the smart traders and investors are doing. So this is what a good chart looks like. That's the benchmark, the golden chalice, if you like, of what a good trend and chart looks like. When you see something like this on one of the home building sectors, one of the areas that you're interested in, then that's what should get you excited. That's the time to put the money where the mouth is and say, yes, this is a good time for me. It's a good trade. It's a good swing trade for the week, the month, or it's a good investment for the year, for the next 2 or 3 years. Whatever is the right thing for you to consider, that's what it looks like. Again, hopefully I've articulated that, with just some nice visual illustrations.
No, absolutely. Fascinating technical analysis, and appreciate you going through that, and appreciate you for joining me here this week. And hopefully we do this again next month.
Maybe we do. It depends on the feedback, I suppose. Give us a thumbs up if you leave a comment below wherever you're watching this. And if you want another installment, maybe we can make it a regular thing and see if we can match up some of our expectations of what's happening on the sector and come back and review whether maybe we can show you some of the trades then, because I am placing some trades in this sector. Maybe we can look at some of those next month and see how they turned out.
I'd love it. And speaking of regular things, where can people find and subscribe to your Rebel Traders podcast?
Well, they can Google or podcast, whatever podcast player you choose. You can go to Rebel Trader if you want to listen to me talk about this stuff every week. My main website is at antivestor.com. It's antivestor.com. It's a mashup of 2 words. And if you want to email me, feel free to. I can write that down. Just bear with me a second.
And for those on the podcast,
let me just get my scribble screen.
Phil at antivestor.com. Yeah.
So Phil at, and it's antivest and it's a .com. And I've got, just like a doctor, I've got chicken scroll handwriting.
That's some cool, I like that, whatever the hell that stock loader chart thingy you had was. That was outstanding.
Oh, the chart software. That was, if anyone's in, that was TradeStation. I'm not affiliated with them. I don't get paid to say it. I just use them, like them as a charting platform. Yeah. So yeah, tradestation.com. Again, not affiliated with them. Brokerages. There we go. Thanks, Amy. Pop in the comments in the chat box. Let's just put that there. We should have done that. Fill out anti-investor. Brokerage, I suppose, again, not affiliated with them. Please seek financial advice. Find out the right brokerage platform for you. If you're thinking about trades or investments, maybe you can go and look at Think or Swim. It's owned by TD Ameritrade. I like them. I use them, not affiliated with them. It's just a platform I use. Alternatives will be Interactive Brokers. Tastyworks is a good platform. I like to trade stock options specifically. So they're great platforms for that type of trading vehicle. But yeah, there's lots of choices if you want to start looking at that. Again, I'm not affiliated with them. They're just a couple of choices that I personally like and I've got direct experiences with. And again, there's plenty of choices out there, but they're some of the best in my viewpoint.
Awesome. Well, Phil, thank you again. Really enjoyed the conversation, and let's do this again.
Well, thank you for having me.
All right. And to our attendees, thanks for spending some time with us this afternoon on Let's Talk Housing Stocks. Have a great afternoon, everyone. And we'll see you soon on TMC Connect. Take care.